President Ferdinand Marcos Jr. has embarked on a significant three-day visit to the United States to engage in high-stakes negotiations with President Donald Trump, focusing on trade and security issues. A primary objective of the visit is to address the impending 20% tariff on Philippine exports, set to take effect on August 1, 2025. This tariff increase, which unexpectedly rose from an initially announced 17%, threatens to impact the Philippine economy by raising the cost of goods in the U.S. market, potentially reducing demand and affecting local exporters. Finance Secretary Ralph Recto, along with Trade Secretary Cristina Roque and Economic Planning Secretary Arsenio Balisican, is leading efforts to negotiate zero duties on select products, particularly in agriculture and mass-produced goods. These negotiations are vital, given the Philippines' $5 billion trade surplus with the U.S. in 2024, and total goods trade amounting to $23.5 billion. The tariff issue poses risks to the country's economic outlook and credit ratings, contributing to a downgraded GDP growth forecast for 2025, now estimated at 5.5% to 6.5%. Beyond trade discussions, Marcos aims to strengthen the U.S.-Philippines alliance, emphasizing its importance for peace and development in the Asia-Pacific region. Amid regional tensions, he also plans to engage with U.S. business leaders to attract investments, which could bolster economic growth and job creation in the Philippines. While Marcos is abroad, governance in the Philippines is maintained by a caretaker committee led by Executive Secretary Lucas Bersamin, ensuring stability. Despite the challenges, there is optimism that the long-standing trade and security relationship with the U.S. will aid in securing favorable outcomes from these discussions.
The financial landscape is witnessing a shift as investors seek new opportunities beyond the well-trodden paths of Dogecoin, DOGE, and Avalanche, AVAX, whose explosive growth phases appear to be over. With their market caps now in the billions, these cryptocurrencies are unlikely to replicate their past 100x gains, prompting savvy investors to explore smaller, high-potential tokens. Two such tokens currently gaining attention are LILPEPE and Algorand, Algo, both priced under 40 cents and positioned for substantial growth due to their innovative features and strategic market positioning. LILPEPE, a LAYER2 Ethereum-compatible blockchain, is making waves with its zero-tax tokenomics and sniper-bot protection. The token is in stage 5 of its pre-sale, priced at $0.0014, with expectations of a post-launch price of $0.003, offering early investors a 114.28% gain. Projections suggest a potential rise to $0.164 by Q4 2025, translating to a 117x return for current buyers. Meanwhile, Algorand, Algo, is gaining traction for its real-world applications, such as facilitating cross-border transactions and supporting central bank digital currencies, CBDCs. With recent ecosystem growth and technical strength leading to a 30% price surge, Algo is poised for further appreciation, offering a more secure investment with strong infrastructure and developer support. As the cryptocurrency market evolves, Lil Pepe and Algo present compelling opportunities for investors seeking significant returns, while Doge and AVAX have matured into large-cap assets. These emerging tokens offer a blend of innovation, utility, and growth potential, making them attractive options for those willing to take calculated risks in pursuit of substantial financial gains.
The Aurora Pacific Economic Zone Authority, APECO, has unveiled an updated master plan aimed at segmenting its area into specialized zones to attract diverse investments across aviation, agri-aqua, tourism, and other industrial sectors. APECO's president and CEO, Gil Taway IV, emphasized the strategic positioning of the Aurora Ecozone as a potential defense hub, given its proximity to key Indo-Pacific regions and the U.S. Pacific Fleet. The revised plan includes significant infrastructure developments, such as extending the airport's runway and constructing new facilities to support aviation activities. This strategic zoning is intended to create a more integrated and efficient space for business operations, enhancing the ecozone's appeal to investors. The updated master plan reflects a shift from a previously disjointed layout to a more cohesive structure, with zones logically placed to support complementary industries. This reorganization is expected to enhance operational efficiency and attract private sector participation through joint ventures. APECO's initiative aligns with broader governmental efforts to bolster national defense capabilities and economic growth by leveraging strategic geographical advantages. The master plan, scheduled for presentation to the board in September, could significantly influence investment flows and regional economic development, positioning APECO as a critical player in the Indo-Pacific economic landscape.
Palantir Technologies, Inc., NASDAQ PLTR, recently saw an increased investment from Sargent Investment Group LLC, which boosted its holdings by 10.9% in the first quarter, now accounting for 7.6% of the firm's portfolio, making it their second largest position. This strategic move comes amidst a broader trend of institutional investors increasing their stakes in Palantir, with significant contributions from entities like Geode Capital Management and Northern Trust Corp. The heightened interest among institutional investors suggests a strong confidence in Palantir's future performance, particularly as the company continues to expand its presence in both commercial and government sectors. Despite the insider selling activities by key executives like Alexander C. Karp and Ryan D. Taylor, Palantir's stock remains robust, trading at $153.52, with a 12-month high of $155.68. The company's recent quarterly earnings report showed a 39.4% increase in revenue year-over-year, aligning with analyst expectations. However, the stock's high P/E ratio of 667.48 indicates that it is priced for significant growth, which might be a point of caution for potential investors. Analysts have mixed ratings on Palantir, with a consensus rating of hold and an average target price of $91.37, reflecting a cautious optimism about the company's long-term prospects. This mixed sentiment underscores the importance of closely monitoring Palantir's strategic moves and market performance in the coming quarters.
Oracle Corporation, NYSEORCL, has seen notable activity in its stock holdings, with FAS Wealth Partners, Inc., reducing its position by 3.5% during the first quarter. Despite this reduction, Oracle's stock remains a focal point for institutional investors, with entities like Harrell Insurance Investments and Financial Services Limited and Rockland Trust Company increasing their stakes significantly. The company has been under the spotlight due to insider trading activities, with significant stock sales by insiders such as Clayton M. McGuirk and Vice Chairman Jeffrey Henley, which have caught investor attention. Analyst sentiment towards Oracle remains largely positive, with several brokerages revising their target prices upwards. For instance, Scotiabank initiated coverage with a sector outperform rating and a $300 price target, while Piper Sandler upgraded the stock to overweight. Oracle's recent earnings report exceeded expectations, with a reported EPS of $1.70 against a consensus of $1.64, and revenue reaching $15.90 billion, marking an 11.3% increase year-over-year. This strong performance, coupled with a robust market cap of $689.01 billion and a strategic focus on cloud services, underscores Oracle's significant role in the enterprise software sector. Oracle's financial health is further supported by a quarterly dividend of 50 cents per share, indicating a stable return for investors. The company's diverse product offerings, particularly in cloud services, continue to drive its growth and market presence. As Oracle navigates through market dynamics and investor activities, its strategic initiatives and financial performance will be critical in sustaining its competitive edge and delivering shareholder value.
Meridian Wealth Advisors LLC has increased its stake in the Vanguard FTSE Developed Markets ETF, NYSEARC AVAX, by 4.2% in the first quarter, as per its latest SEC filing. The institutional investor now holds 116,181 shares valued at approximately $5.9 million, making the ETF 1.0% of its portfolio. This move aligns with a broader trend where several institutional investors, including Up Strategic Wealth Investment Advisors LLC and Financial Synergies Wealth Advisors Inc., have also increased their holdings in VAX, indicating growing confidence in developed markets outside the U.S. The Vanguard FTSE Developed Markets ETF, with a market capitalization of $163.56 billion, tracks a market cap weighted index of large, mid, and small cap stocks from developed markets excluding the U.S. The ETF's price performance has been strong, with a 52-week high of $57.39 and a low of $45.14, reflecting positive investor sentiment towards developed international markets. The ETF's beta of 0.89 suggests it is less volatile than the overall market, which may appeal to investors seeking stable exposure to international equities. This trend of increased institutional investment could signal a strategic shift towards diversification amid global economic uncertainties.
ABBV Inc., NYSE, ABBV, has been the focus of significant institutional investment activity, as evidenced by the latest filings from various investment firms. Bingham Private Wealth LLC recently reduced its stake in ABBV by 7.8% during the first quarter, now holding shares worth approximately $1.35 million. This adjustment places ABBV as the firm's 17th largest position, representing 1.4% of its portfolio. Meanwhile, larger institutional players like Norges Bank and FMR LLC have made substantial investments in ABBV, with Norges Bank acquiring a new position worth over $4.4 billion in the fourth quarter. As of now, institutional investors and hedge funds collectively own over 70% of ABBV's stock, indicating strong institutional confidence in the company's financial health and future prospects. ABBV's recent financial performance has been robust, with the company posting a quarterly earnings per share (EPS) of $2.46, surpassing analyst expectations of $2.40. The company's revenue for the quarter was $13.34 billion, marking an 8.4% increase year-over-year, driven by its diverse pharmaceutical offerings, including treatments like Humira and Skyrizi. Despite this positive performance, AbbVie's stock recently opened at $189.26, reflecting a slight decline of 1.1%. Analysts have mixed ratings on the stock, with a consensus rating of moderate buy and a consensus price target of $211.29. The stock's dividend yield remains attractive at 3.47%, with a quarterly dividend of $1.64 per share, signaling AbbVie's commitment to returning value to shareholders amidst a competitive pharmaceutical landscape.
GE Aerospace, NYSE GE, has seen significant trading activity recently, with Souders Financial Advisors reducing its stake by 29.6% in the first quarter, selling 6,285 shares, according to its latest 13F filing with the SEC. Despite this reduction, the firm still holds 14,919 shares valued at approximately $2.99 million. Concurrently, other institutional investors have adjusted their positions, with the Teachers Retirement System of Kentucky and J.W. Cole Advisors, Inc. notably increasing their holdings, highlighting diverse investor sentiment towards GE Aerospace. The company has received positive attention from analysts, with several upgrades and increased price targets. Wall Street Zen upgraded the stock to a buy, while firms like Wells Fargo, Citigroup, and UBS Group raised their price targets, reflecting optimism about GE Aerospace's future performance. The stock, which opened at $263.49 recently, has experienced a 1.2% increase and is trading near its 52-week high. This bullish sentiment is supported by GE Aerospace's strong financial performance, with its latest earnings report revealing a 21.2% year-over-year revenue increase and an EPS that surpassed expectations. GE Aerospace's robust financial metrics, including a return on equity of 31.32% and a net margin of 18.64%, underscore its solid market position. The company also announced a quarterly dividend, maintaining a payout ratio of 20.08%, which offers a modest yield of 0.55%. As the aerospace giant continues to show strong growth and profitability, it remains a focal point for investors and analysts alike, who are closely monitoring its strategic moves and market performance.
PKM Wealth Management LLC has reduced its stake in International Business Machines Corporation, NYSE IBM, by 1.5% during the first quarter, holding 8,009 shares valued at approximately $1.99 million. This move comes amidst broader institutional interest in IBM, with major investors like Vanguard Group, Geode Capital Management, and Capital World Investors, significantly increasing their holdings in the company during the fourth quarter. Vanguard Group, for instance, expanded its position by 1.7%, now owning shares worth over $20 billion. Such institutional activity suggests a mixed sentiment towards IBM, balancing between profit-taking and strategic accumulation. IBM's stock performance remains robust, with a recent opening price of $286.04. The company's financial health is underscored by a current ratio of 1.01 and a quick ratio of 0.97, indicating adequate liquidity. The tech giant reported a quarterly revenue of $14.54 billion, slightly surpassing analyst expectations, and an EPS of $1.60, which exceeded forecasts by 18 cents. Despite a high price-to-earnings ratio of 49.23, IBM maintains a strong dividend yield of 2.35%, having recently increased its quarterly dividend to $1.68 per share. Analysts maintain a consensus moderate buy rating with a target price of $266.19, reflecting cautious optimism about IBM's future performance amid its ongoing transformation through hybrid cloud and AI platforms.
LANDBANK has launched the AGRISENSO Plus lending program in Western Visayas, aiming to empower over 1,500 farmers in Iloilo by providing accessible financing and support to small farmers, fishers, and agri-enterprises. This initiative, rolled out on July 11, 2025, represents the sixth nationwide implementation and the first in this region, known for its agricultural productivity. The program offers a fixed interest rate of 4.0% per annum, along with simplified documentation, free insurance, and expanded access to technical support, catering to a wide array of agricultural stakeholders, including micro, small, and medium enterprises, MSMEs, and large enterprises. The AgriSen's O Plus initiative is part of LANDBANK's broader strategy to enhance the agricultural value chain through integrated support and capacity building. It includes partnerships with various private sector entities to connect borrowers to market opportunities, and the introduction of the AGRISENSO Plus card, which facilitates digital banking for farmers and fishers. Since its inception, the program has disbursed 1.16 billion pesos in loans, benefiting 6,853 borrowers across the Philippines, thereby reinforcing LANDBANK's commitment to fostering countryside development and bolstering national food security.